computing is very much back in style in the Wall Street fashion show. I think this group could have a lot more room to run, given its tremendous growth prospects, particularly in the quarters we've seen this year. Just look at Workday, the cloud-based provider of software that helps businesses with everything from human capital management, think HR, to payroll, to employee expense management, and procurement, and finance. When you bring in Workday, your business can generate a lot of savings by automating various non-revenue generating back office functions. Not so great if you're worried that artificial intelligence is going to put us all out of work, but terrific if you're a shareholder. Now, Workday stock has already run up more than 50% year to date, and the company just showed us why. Because it is deserving after reporting a terrific quarter after the close. Workday posted a 13-cent earnings beat off a 16-cent basis non-GAAP, with higher than expected accelerating revenue growth, up 38% year over year, management raising its full-year subscription revenue guidance to boot. So let's take a closer look with Aneel Bhusri, the co-founder and CEO of Workday. Hear more about the quarter and where his company is headed. Mr. Bhusri, welcome back to Mad Money. Well, Aneel, after I see this quarter, it looks like you're going to be the second software-as-a-service company to be able to crack that $2 billion barrier, or you're already well on the way with this quarter.
It was a strong quarter across the board, Jim. We saw re-acceleration in our subscription revenue business for the second quarter in a row, so feeling really good heading into the rest of the year.
You want a company that I have great esteem for, that knows technology better than anyone in the financial services. Frankly, they don't get enough credit for it, which is NASDAQ. I did not know you won that. What are you going to be doing for them?
So they were already a human capital management customer. They're now expanding their use of Workday to include our financial management products. So that's a really big win for us. And their CEO, Adina, is terrific, and she was actually very involved in the sales cycle.
Now, one of the things that I think people have to recognize is that there are three big retailers in this country everybody knows. They know Amazon, they know Walmart, and they know Target. You've taken all three of those this year.
We feel very lucky about that. We're going to do a great job for all three. It seems like the retail market is really moving to the cloud in mass right now. So we're trying to get our fair share and then do a good job for them on the customer service side.
Now, I know when companies merge, sometimes you're able to pick up business. A company that we really liked on a deal that made George Barrett bought Cardinal Health. They did some business with Medtronics. Would that be the kind of thing that you would get that Medtronic integration for Cardinal?
Typically, yes, we would. I'm not sure about that specific opportunity. I do know as HP Enterprise spun out their enterprise services business, Workday got that piece of business. So anytime there's a change, combination of them already being a happy customer and then Workday being able to get them into production very quickly usually bodes well for us winning that either M&A or spin-out kind of business.
Well, I want people to understand that all these companies I just mentioned, they could have chosen a much larger company, SAP or Oracle, I would believe, but they went with you, so there's a competitive advantage. Do we have some statistics, independent statistics, that show you a market share gain over the course of the last couple of years?
Well, Goldman Sachs did a recent survey amongst IT professionals, and if you look at what they see today and what they see 3 years out, basically, the CIOs are telling Goldman Sachs that Workday's market share is going to continue to grow at the expense of Oracle and SAP. That's probably the most recent data point that we've seen. It all comes back to having a great product and taking care of customers. Our customer satisfaction rate is still above 95%, right around 97%. And where I think we've really carved out our success has been at the high end of the enterprise, these very large companies where we're really the only proven solution in the marketplace. And that really matters in today's world. It's not just about selling the cloud, it's about delivering the cloud for these companies.
Now, one of the things that you mentioned 3 years out, you've got some pretty interesting artificial intelligence about whether someone will stay or go, a predictive model. Could you just explain to people how sophisticated things have gotten? Because a lot of times, you work at a company, say a 1,000-person company, you say, that guy might be disgruntled. But that has no indication of what will happen. You actually have data points, and you've been able to figure out who's likely to go and not.
So this is that huge move towards machine learning, which I believe is not going to replace jobs. It's just going to make people more effective. But we're able to look at a massive amount of data, and based on things like their current salary, how long has it been since they were recently promoted, how competitive is that job outside the company, we can make a prediction whether that person is likely to leave in the next 12 months. And that's very useful to an HR organization or to a CEO who's trying to maintain their top talent and keep their top talent at the company.
So, I mean, how accurate has the model been?
You know, in the data sets against our own data set, it was about 90% accurate.
Yeah. Wow.
And we're taking that machine learning capability across other parts of the application. So we have a customer collections analytic that will predict if customers are going to pay on time in our financial offering. So those are just a couple use cases of what we can do with machine learning.
Okay, you know, one of the things that I thought was interesting was that you had 20th Century Fox. They were human capital, and now they brought you in as financial manager. And again, 20th Century Fox, very, very big, 21st century, huge company, global. I mean, will you do all the global for them?
So we, like we have done in the past, we have to prove ourselves out at a business unit, and then the goal would be to do as much of 21st Century Fox financials as we're able to. And the same thing applies with CNA, the big insurance company. Right. They also chose Workday. And so we're beginning to get those proof points along with the Netflix of the world and the Aons of the world that large companies are beginning to move their financial systems to the cloud. So it's a very exciting time for us. And
then the last thing I need to show for people, because you know I like your company, I like your stock, operating loss is $60.2 million, negative 12.5. But what I'm looking at is operating cash flow for the first quarter, $180 million, cash and cash equivalents now 2.1 as of April 30th. Those are probably more accurate for our viewers who are trying to say, wait a second, why is Cramer like these guys? They're losing money. That's a better indicator, right? Because of the way you do your financial accounting.
Absolutely, but I'd also say that our marketplace really looks at non-GAAP operating margin, and there we spiked over 12%. So we're, I think, 12.7% positive operating margin, and that's significantly ahead of where we even thought we would come out. And I'm not sure that's going to be repeatable forever, but or at least in the foreseeable future. I think it just demonstrates the scalability and positive nature of our business model.
Well, you're winning the big ones, and I think that's what matters. And congratulations on a better than expected quarter. Neil Bushry, the co-founder and CEO of Workday. Good to see you, sir.
Thank you, Jim. Good to be with you.
Right now, the stock is run, so understand. I mean, this may be one of those situations where it has moved up, but I think it should move up even more because this is a much better than expected quarter. Certainly better than I was looking for, and I have liked this company for a long time. Stay with Cramer. Booyah! Jim Cramer here from Mad Money. Thanks for watching CNBC on YouTube. Click here to subscribe and get the jump on my exclusives with CEOs, plus market news, investing advice, and a whole lot more.